Good morning, everyone. Tim Nyland here. Today is Wednesday, March 3rd, and this is our weekly strategy call for Zacks Professional Services. Each week, we focus in on what's moving the market. If you have a topic you'd like me to explore in a future video, please leave a comment below. You can check out previous strategy calls on our channel, and you'll also find many more videos on investing and making the most of Zacks Pro platforms. And don't forget to hit the subscribe button below to make sure you never miss any of our future calls. Last week, we took a look at the valuations of growth versus cyclically sensitive portions of our economy. And we did that relative to the S&P 500. And from there, we moved on to the Zacks Earnings Certain family of equity model portfolios. And we uncovered how it's never been cheaper relative to the S&P 500 over the prior 20 years to basically begin moving into that strategy, if that is of interest to anyone. And what we're going to do today is a little bit of an extension of that. We're going to focus in on one sector in particular, which is big pharma, and talk a little bit about how some of these names have been left in the dust, if you will, during this most recent cyclical rotation. And in order to do so, what I wanted to do first was bring in the Advisor Tools quote monitor. And you can see that I have the three big pharma names up on the screen here that we're going to talk about today. Johnson & Johnson is the first one. They're obviously a member of the Earnings Certain portfolio. And I actually have tabbed over to the Zacks Research tab in my quote monitor because I wanted to show the ranks and kind of get this out of the way first and talk about these consensus models as well. And since we're talking about big pharma, obviously a lot of the valuation is going to depend upon the drug pipelines themselves. And so obviously reading the analyst written research report, which is right here, these PDF files, is going to be really, really important for getting your arms around what type of drugs might be coming off patent and any of the other issues related to big pharma. And you'll also note that we're going to talk about Pfizer and Merck. They are both Zacks Rank 3s, which are holds. And I don't want to mislead anyone here. I'm not telling everyone to go out and buy Pfizer and Merck right now. But what we're going to do is we're going to dive into the valuations here in a few minutes. And I'm going to show you why now is the time to put these on your radar so that when the Zacks Rank does turn to a buy, in other words, we take a look at and collect from all of the sell side. We maintain working relationships with the sell side banks in Wall Street and collect all of the estimates. And what we do again with the Zacks Rank is we look at the analyst agreement, the magnitude, the upside potential, and the surprise factors. And we determine with the Zacks Rank which stocks are more likely to continue to receive positive and or negative estimate revisions in the near term. And so once Pfizer and Merck move into Zacks Rank 2 or perhaps even Zacks Rank 1, then we know we've got underlying momentum building amongst the analyst community across those four factors, and we can begin perhaps looking at allocating some assets into those names. So don't run out and buy these two names now, but we're going to show you why there's some strong evidence that from a valuation perspective, we need to be paying attention. So obviously some big issues with pharma. We've seen stocks related to the COVID vaccine just take off, BioNTech, Moderna, Novavax. And then we've seen others like Pfizer, like Merck, that haven't done so well during this time where other pharma companies have just taken off. And the idea here that you've got to understand is that Wall Street is going to tend to place a low valuation on these massive drug sales if these drugs themselves face any sort of a short shelf life or there is competition amongst other providers that are not necessarily protected under patents. And so we are, or expiring patents. So we're kind of experiencing a lot of this right now with FERC and with Pfizer and Merck. And I do encourage everyone to read those analyst written research reports. They're actually really good. Talk about some of these risks. So the idea here is specifically for Pfizer and even Johnson and Johnson, even if these annual booster shots did become standard care, the standard of care for COVID-19 vaccinations, we're already seeing that there's lots of competition amongst drug manufacturers for COVID vaccines, and that's likely going to mean pricing competition. So all of this is being discounted. So the idea is make sure when you're investing in these pharmaceutical companies that you have a really, really good understanding of the risks. And again, in the research reports themselves for Merck, we do a really, really nice job of outlining the reasons to buy and the reasons to sell. So a really, really good, neutral, unbiased report. Same thing for Pfizer. I've got that up on the screen now. A nice overview. We discuss in detail the reasons to buy and obviously the reasons to sell. Same thing with Johnson & Johnson. Johnson & Johnson obviously has the protection of the consumer staples side of the business as well. It tends to be a little bit more stable, which is why it's obviously a member of the earnings certain portfolio. But still, same reasons to buy, reasons to sell section. And they talk about pipeline setbacks, patent expirations, and everything else. So a few minutes ago, I mentioned the fact that we do maintain relationships with Wall Street and the sell-side research firms, the sell-side banks. And we actually collect not only the research reports and not only the underlying estimates, but we actually collect the actual analyst models as well. And for all of those contributors that allow their models, in other words, their line item, detailed estimates to be contributed to Zacks consensus, we go ahead then and aggregate those numbers and publish what we call the models. And since we're talking about big pharma, this was a really, really nice opportunity to show what some of these models look like. And again, you've got access to these in Advisor tools. It's very, very easy to find these. From the quote monitor, you literally just click on from your equity research class, if you will. You literally just click on the Zacks Research tab. So you'll start an overview, move to Zacks Research, and then you'll see these consensus models where they're available. And so I've got one up on the screen right now. We'll just take a look at Pfizer's. And again, we start with disclosures. There's several tabs. You've got your summary. These are going to be all your line item consensus with year-over-year growth rates. The neat thing is that from here, we're going all the way out to 2023 on this Pfizer model. And you can literally take and split the annual numbers into the 4 quarters, and you can actually see how the 4 quarters roll up into the annual just by breaking this out. The consensus model itself is going to have all of your line items, and we're going to be showing actuals as well as estimates. Okay, so you can kind of see how that works. And then probably the most exciting part for the pharma community at large is the drug pipelines that we actually show. And again, we're looking at actual information. And then we actually roll into some really, really interesting estimate information, in some cases going all the way out to 2030, as you can see here with Pfizer. We talk about the stage of development, at least outline that. And again, keep in mind, this is all consensus from our contributors on the sell side. And you'll see here all of the drugs. This is internal medicine, Eliquis, Chantix, obviously everybody's heard of that. But at any rate, you can literally scroll through, go through all the oncology drugs. Those are going to be your cancer drugs, and on and on. And you literally just, scroll through. And you can look at all of these estimates. You can see when these drugs are coming off patent. Then you can see that the forecast revenue tends to drop substantially at that point. Okay, so here's all your vaccines, inflammation, immunology, rare disease, on and on. Very, very complete. And keep in mind, I've got the consensus models up for Merck as well. Again, when you're investing in these big pharma, it's a good idea to just have a feeling for what their pipeline looks like, and reading our analyst written research reports, along with just taking a browse through these consensus models, can be helpful. Same thing with Johnson & Johnson. Okay. Key financials are great too. The key financial section's available on most of the reports. It's going to literally give you line item consensus for all your balance sheet, cash flow, CapEx, dividend metrics, book value, those sorts of things. If you're looking at a retail stock like a Walmart, you'll have sales per square foot estimates, the whole 9 yards. So Keep in mind that they're very, very specific. Again, these are the actual models that are coming in from the sell side analysts, at least the ones that allow their numbers to be contributed to our consensus. We will be aggregating those and showing those to you. So not to beat a dead horse, but again, available to everyone subscribing to Advisor Tools through the quote line. Okay. So what I want to do now for the next few minutes is talk a little bit about these three stocks and why we are talking about them today, which is the most important part. Keep in mind that Johnson & Johnson, obviously an earnings certain stock, currently Zacks Rank buy. Solid earnings stability, a little bit of a reopening phenomenon here for Johnson & Johnson, but not too bad. And where I want to go with this, I want to show everyone in the research system, I've loaded the three symbols up here so we can just do some matrix navigation really quickly and kind of bump through these slides. I've also utilizing my profit and leverage pitch book. I've used this pitch book before in prior webinars. Absolutely love this collection of graphs. And we'll be flipping through a few of these here right now. But what I want everybody to take a look at for Johnson & Johnson, Merck, and Pfizer is literally the price action relative to its trailing 4 quarters operating earnings. And that's what each one of these points are. It's literally a trailing 4-quarter number. And specifically, when we start getting down into Merck and Pfizer, you're going to see that these stocks tend to consolidate every so often. And again, I'm not saying run out and buy Merck right now. It is a Zacks Rank hold, and it can get cheaper. Okay. But you'll see that back here in 2009, 2010, 2011, we had some real uncertainty about the company's ability to deliver on earnings. And you can see that it actually hugged the earnings line for quite some time before the buy-side community actually gave it a PE multiple expansion. And interestingly enough, it gave it a PE multiple expansion on this earnings trough here before this rebound ultimately occurred. And now we're in a period of that consolidation again. We've actually been in that period of consolidation literally since the end of 2019. Okay, so it can get cheaper, but now's the time to start keeping an eye on this thing. Know the pipeline and wait for the Zacks Rank to turn to buy. That's going to tell us that we've got underlying momentum with the analyst community contributing estimates. Okay, same thing with Pfizer. A consolidation period here, a PE multiple expansion, and now we've got this earnings catch up, and the stock has literally just been sitting flat for, the better half of at least a year and a half. So things are getting interesting for sure. And what we want to do is we want to take a look at the PE multiples. And right now, I've got this set to global sector. We'll start out just by looking at Pfizer's PE relative to the S&P 500. And just like the similar analysis we did last week where we looked at growth versus value, and we did that for the earnings certain portfolios as well, you'll see that Pfizer, with an indicated yield of literally 4.63%, now sitting at valuations that are comparable relative to the S&P 500 to the lows that we experienced in the financial crisis. And so, with a yield of 4.63% and the fact that this stock has been consolidating for quite some time, it's worth putting on our radar and at least being aware, Pfizer being a major player, obviously, in the COVID vaccines as well. As a material player in big cap pharma, these are core names that we need to be aware of. And if we take a look at this thing relative to the global sector, which is basically healthcare, you can see literally since 2013. I mean, this has just gotten cheaper and cheaper and cheaper. Okay, so we can do a similar analysis for Merck. You can see the same thing. Johnson & Johnson probably in a little bit different boat. Still inexpensive, but bouncing around again. It has that consumer discretionary, consumer staple component that tends to anchor its valuations a little bit better than Merck and Pfizer. But at any rate, we can actually bump this all the way down to the sub-industry, and we can take a look at these valuations relative to large cap pharma. And you can see that all in all, we're still pretty darn inexpensive for Merck. Pretty inexpensive for Pfizer, definitely at the low end of its range. So again, worth keeping on the radar. The thing that I really, really love about these names is when we start looking at the metrics that really, really matter for long-term buy and hold investors, which is what we like to think of ourselves as. When we look at these metrics relative to the broader market, and again, back in my profit and leverage pitch book, really like focusing on return on assets, return on equity, return on total capital, free cash flow, return on invested capital. And you really, really can't get much better than big cap pharma for if you're looking for stocks that are basically, compounding the return on capital to common equity shareholders. Take a look at this return on assets. The market weighted average stock in the S&P 500 is literally clocking in at about 3.7. The median over this particular time period, which if I do a right mouse click is about 20, 25 years. The median's 4.2. It's clocking in right now at 3.7. Johnson & Johnson is literally 15 median with a 13 current. We're talking an order of 4x magnitude greater return on assets for Johnson & Johnson. And we take a look at return on equity. This shouldn't surprise you because this is an earnings certain stock. And these are some of the qualities of earnings certain stocks. And this is a byproduct of that discipline that we go through. And you can see the same thing for return on capital, right? So more than 2x the S&P 500. One of my favorites, again, especially when we're taking a look at companies that pay a little bit higher dividend, that free cash flow return on invested capital, again, clocking in at 2x the S&P 500. Now what you're going to see that might surprise you is how good the numbers also look for Merck and Pfizer. Okay, at least the valuations being as cheap as they are, we've got a free cash flow return on investment at least roughly equal to the S&P 500. And its return on capital is actually almost 3 times that of the S&P 500 for Merck. Okay, we start looking at ROE. Now we're 2.5 times. I mean, this is really, really solid metrics here for Merck. Again, a core holding in big cap pharma. Return on assets, again, a factor of 4x, just like we saw with J&J. And Pfizer as well, a factor of 3x return on assets. Again, that ability to compound returns to capital, to common equity shareholders, higher than the S&P 500. And again, we're getting these stocks at a substantial discount to the S&P 500 right now in terms of price to year forward earnings multiple. Return on capital, 40% higher than the S&P 500. And then obviously free cash, roughly equivalent to the S&P 500. So not bad with a 4.63% indicated yield. So at any rate, something to think about this week. Do not leave big cap pharma off your list of companies. These are companies that are currently trading at tremendous value right now. Since we're talking about value rotations and the cyclical rotation that's been going on, you've got Pfizer and Merck that have more or less been left in the dust. And so you're going to want to keep your eyes on them. Again, I don't want you to run out and buy them now, but wait for that Zacks Rank to more or less flip to a buy, do some additional research, make sure it's right, and then maybe take a dip in at that point. But again, just to kind of show you that price and earnings chart out of the research system again for Merck and Pfizer. Very, very compelling consolidation going on right now. Again, that PE multiple literally contracting on rising earnings at the same time we've got price cascading, which is obviously what you want to see for a nice value play. That's about it for this week. If you find this video helpful, please hit the like button below and be sure to subscribe for future videos. If you have any questions or requests, please leave a comment below or feel free to email me at tnyland@zacks.com. You can also follow me on social media. I'm on LinkedIn and my Twitter handle is @TimNyland. Again, I don't have a PowerPoint presentation for this particular strategy call. This was done live using advisor tools and the research system. If you're interested in getting a hold of any of the research reports or the consensus models that I showed, we're more than happy to email those out to you. go ahead and contact our world-class support at advisortools@zacks.com, or you can also email zrs@zacks.com. If you're interested in getting started with Advisor Tools or the research system, or you're just looking to upgrade your current subscription, also just reach out to us. We're more than happy to assist. Thank you very much for watching, and I'll talk to you next week.